Good evening, everybody. Welcome to week 7, Accounting 203. My name is Professor Hasse. Tonight we're going to, as you can see on your screen, talk about a wide variety of topics. One last little look at the midterm examination. We still have some students who have yet to select the companies for the project paper, where you select a firm, download their 10K financial information, and answer a series of questions and put them into a paper format. We'll be going over that a little bit. Then we're going to be doing one more problem from Chapter 9, recording the bad debt expense and the allowance for doubtful accounts. We then also will be talking about how to calculate depreciation. In the past, when I gave you a depreciation adjusting entry, the number was given to you. Now we're going to learn how those numbers are calculated, doing problem 10-2A in your textbook. Then we're going to talk a little bit about current liabilities and all the different types of liabilities there are for a company, all the different types of debts. And then we're talking about, finally, and we might not have enough time tonight, but we'll definitely finish it up next week, is corporate accounting. How do you record a journal entry to record the issuance of stock for a company? Up to this point in time in all our work in the accounting cycle and retail accounting, we've been dealing with firms that have basically one owner, capital account. Now we're going to be taking a look at how equity is calculated and accounting-wise for corporations, the issuance of stock. And so we'll be talking about that from Chapter 13. After our break, posted to Blackboard will be quiz number 3, which will be 3 problems from Chapters 8, a bank reconciliation problem, 9, a journal entries to record the adjustment of bad debt expense, and Chapter 10, our discussion this evening of calculating depreciation expense for a plant asset. That'll be your quiz. And then next week, our 8th week, we'll talk about Chapters 18 and 19. So that's our schedule for this evening, and it looks like we have rather a sparse crowd in the audience. 8 of 16 students, about half, are attending this evening. What should I make of that? A, we're busy. B, I don't care about accounting anymore. C, I'd rather watch the Yankee-Washington baseball game or the Dodger-Giant game this evening. All legitimate excuses and reasons. We have a chat. Elijah is a Yankee fan. Sorry to hear that, Elijah. You just lost 5 points on quiz number 3. That's a joke, sorry. Yankees. How can somebody from Santa Maria be a Yankee fan? You should be a Giant fan. I don't understand that. Okay. Well, welcome all of you. I hope you're doing well. We have 3 more weeks after tonight of this class, and I commend all of you for hanging in there for a subject that is not what you call exciting, but you're all doing well and you're all learning. And that's the best we all can do. And I know you're all doing the best you can. So let's talk about one last time a bad debt expense. Let's bring up something here. Here is our Blackboard site and a couple of administrative things to look at for this evening. If you go into week 7, plan assets, there's a spreadsheet there, week 7, spring, I should say summer, I apologize, summer 2020, I'll fix that, which will be a spreadsheet that we'll be using this evening in class and doing some problems. There's these problems, solutions for chapters 10, 11, and 12 that I'll be looking at. They're the solutions right there. We'll also be doing the solutions in this spreadsheet as well. And next week, you're reading out of chapters 18 and 19. You are not required to read all of the chapters. Just concentrate on these pages in your reading for next week. Do not read all the chapters. You're just concerned with those pages, and that'll be my lecture for next week. Okay. All right, let's look at problem 9-2A on page 351 of your textbook. This is similar to the work you're going to be doing on your quiz and similar to the work you're going to be doing in your examination the last week of class. The problem is to determine, based on sales, how much of those sales are going to be considered bad debt. Remember, bad debt is an estimation by a company to determine how many people in the receivables who owe you money will not pay you. And that is that's an important thing for companies. First of all, bad debt expense allows you to expense people who are not going to pay you, and that's reducing your tax liability. It's a business expense. Now, granted, it's not a cool thing. There's somebody, you produce a product or you sell a product and you sell it to them and they don't pay you. Yes, that's not very good. But at the same time, it is a tax deductible expense, and it's something that's why it's so important to record these. So if you look at problem 9-2A on page 351, they tell you in the problem that a company has credit sales in their current calendar year. They have credit sales of $5,682,000. That means billed sales. They also tell you in the problem that the company had cash sales of $1,905,000. So that's their total sales for the year. All right. They had cash sales and credit sales. Naturally, credit sales are usually going to be the main majority of your sales because people can charge it. They pay you later, or you can sell it to a customer and give them an invoice and they can pay you later. Okay. Also, they tell us as of the end of the year in this problem that our accounts receivable balance totaled $1,270,100. That was the accounts receivable balance at the end of this calendar year. Also, the allowance for doubtful accounts had a debit balance, which is unusual for that account, of $16,580. Okay, I'm going to put that over here in a little T account, allowance for DA, a debit column, and a credit column. There it is right there. Okay. And right now on December 31st, they have a debit balance in the account of $16,580. Okay. So now let's begin the problem. We're now going to be making adjusting entries for this year ended, adjusting some of these accounts for bad debt. Okay. First of all, in the problem, it says prepare adjusting entry to record bad debts under the following assumptions. A, and let's call this part 1. Okay. Bad debts are estimated to be 1.5% of credit sales. All right. Based on we talked about this last week. Based on the history of this company, they anticipate of the $5,682,000 of credit sales this year, that 1.5% of that will be bad debt. We're estimating that to be uncollectible. So if we take 5,682,000 and multiply it times 0.015, we're going to get our estimated bad debts for the year, which happens to be $85,230. So our entry would be to debit bad debts expense, $85,230, and credit the allowance for doubtful accounts. Creating an allowance of this year's credit sales that we anticipate being bad debt. Okay. So that bad debt expense is an operating expense for the year. The allowance for doubtful accounts is an asset account, and we now will post that to that account, $85,230. There's the credit going into that account. And that now gives us a balance in the account of $68,650. Let's highlight that. So that's the balance now in the account, $68,650. We've allowed, remember we had a debit balance coming into the end of the year. Now we're recording 1.5% of our credit sales. And there we go. So, okay. The second entry, all right, let's call this part 2. Or yeah, let's just call it, we'll call this part 1A. Keep it all the way the textbook says it. And let's call this B. All right. The next one says B, bad debts are estimated to be 1% of total sales. All right. So now we're going to do it a different way. The first way, part A of this, we determined that 1.5% of credit sales are uncollectible. Now we're going to say that 1% of all sales are uncollectible. Kind of weird, you know, how can you not collect cash? But we're going to, that's a number that a lot of companies use. They just take the total sales, and in this case, the total sales are the cash sales of $1,905,000 plus the credit sales of $5,682,000 times 1%. And if we do that work, our entry we're going to be, I'll just finish it up here. And if I do that, that will equal $75,870. Oops. Yeah, $75,870. So if we do it that way, our entry would be to debit bad debts expense, $75,870, and credit sad debt expense. Yeah, that's pretty well it for most companies. Bad debt expense. And we would credit the allowance for doubtful accounts. $75,870. Okay, that's part C of this problem. 1.5%, 1%, 1.5% of credit sales, 1% of total sales. And then in part C, another way of calculating bad debt, given in the problem. An aging analysis estimates that 5% of the year-end accounts receivable are uncollectible. That 5% of the year-end accounts receivable is uncollected. All right. Well, that's an interesting scenario. We're going to take our accounts receivable balance at the end of the period, which is the $1,270,100, and take 5% of that. So let's do that. So our accounts receivable balance here in part C is $1,270,100, and we're going to take 5% of that, and we get $63,505. Oh, excuse me, I beg your pardon. We get 80,000, good arithmetic, Mr. Hasse, $80,085. Let me double check that because something looks funny here. 1,270,100 times 0.05. Excuse me, I was right.
63, yeah.
63,000. You know, I spend hours preparing for class and I still screw up. $63,505. Well, that should now be the balance in the allowance for doubtful accounts, $63,505. But remember, all right, forget these here because this was transaction A, okay? Remember, we started out the period with a debit balance of $16,580. Well, per this method C, we're supposed to have an ending balance on the credit side of $63,505. Well, what entry do we have to adjust to get to that $63,505? We have a debit balance now. We want to get to $63,505. We have to add these two together, and the entry would be bad debts expense. What's wrong with my printer here? Bad debt expense, $80,085 debit, and credit the allowance for the doubtful accounts. $80,085. Because with this entry of debiting bad debt expense and crediting the allowance, if we would credit the allowance account for $80,085, that coupled with the debit balance of $16,580, we now will get our ending 5% of the accounts receivable balance, $63,505. So the reason this problem was created was to give you 3 different ways of companies allocating bad debt expense. 3 different ways that the companies can select. Now, these 3 different ways might be recommended by their public accountants. These 3 different ways could be recommended by history, by what has proved them historically the correct method that they estimate, whatever. The first way, taking a percentage of credit sales. The second way, taking a percentage of total sales. And the third way, taking a percentage of accounts receivable balance to indicate what the balance in the allowance account should be, and then adjusting the allowance account to get to that $63,505. So that's how you would, those are 3 different ways of recording a bad debt expense. putting money aside into the allowance account. Remember, why did this have a debit balance? That must have mean we've wrote off individual accounts during the course of the year, taking it out of allowance account and crediting accounts receivable. And we probably wrote off individual direct accounts receivable accounts more than the allowance balance that we had during the year. Thus, we got to a debit balance. So now we have to replenish that account by these 3 different procedures. You select one. You can't do all 3. You select one. Percent of credit sales, percent of total sales, percent of accounts receivable. So let's say we select letter C. Let's say we select that. How will that show up and look on our balance sheet? Well, under current assets, it will say accounts receivable, $1,270,100, and then it would say less allowance Mr. Hassey, for doubtful accounts minus $63,505. Thus, we have a accounts receivable balance net of that $1,206,595. That's how it will appear on the balance sheet. You're showing you have your receivable balance, and this is the money you've allocated for writing off specific individual bad debt accounts or accounts receivable, and there's the balance in the balance sheet. This account has a debit balance. This account will have a credit balance. And that's how we would do this. So those are 3 methods of writing off bad debts based on a percentage of the activity of the company, either in sales, credit sales, total sales, or accounts receivable balance. Problem 9.2a, this spreadsheet will be posted to Blackboard after tonight, and it's something you'll have a question on in the quiz this week, and also on your examination in a few weeks. How to record the bad debt expense.
Yeah.
Question?
Yes. Could you identify question 2 and 3 in the spreadsheet, please? For reference.
I don't understand the question.
Well, the problem 9-2A.
Yes.
There's 3 questions.
Well, I just answered question 2.
Yeah,
right here.
Right there. Okay.
And well, this is question 3. All right. Okay. You can do question 1. Or question 2, which is just doing. I'll do it for you. Okay. Let's do it that way. All right. So in question 2.
It's just using 1C. Yeah, no, I get that one.
All right. And question 2.
It's using 1C's numbers, yeah.
Question 2 would be this. From 1A, all right, here we have a bad debt expense. Let's get rid of this. It would be $68,650. I would post this here. I would end up having an allowance account of $68,650. So here, this would be $68,650. Whoops. This would be $68,650. And that's how that would look like All right, so this is 1A. This is 1C. Okay, that's how it looked like in the balance sheet. All right, this is a posting here, and then I'll do this down here. This would be the posting for right there. There we go. So this is 1A. This is 1C. There you go. Thank you, Bianca. That makes a little bit more sense to you guys. Thank you. So there it is right there. This is the journal entry or the adjusting entry on December 31st to adjust those accounts. 3 different methods, 3 different interpretations. And here's what the balance sheet would look like for those interpretations. Okay, I will save that and post it later. Thank you, Bianca. That helps.
No, thank you for doing that.
Okay, again, this is a template for an entry to adjust the company's accounts for bad debt expense at the end of a period of time. And why do we do this? To properly account for, because if you just put down on your accounts receivable, oh, people owe us $1,270,100. The first thing your public auditors will do, the CPAs would say, you really think you're going to collect all those? Because we're looking at what you guys did last year, and you didn't end up collecting all those. Some of those ended up being bad debts, not written off. So shouldn't we adjust the accounts based on a system, like we talked, and make sure we're properly allocating what we think is going to be collected? And that's why we do that. In Chapter 8, we talked about the internal controls of reconciling cash, your largest account in your accounting chart of accounts, making sure you reconcile cash to the bank account, to your bank account. In Chapter 9, we're controlling and making sure we properly account for our receivables. Will we properly collect the amount of money we think from the people who owe us money? In Chapter 10, we're properly recording the expense of an asset over time. In Chapter 11, we're properly recording the adjustments to liability accounts during the course of their lifetime. And we'll talk about that this evening. Okay. Excellent. We'll get back to this spreadsheet in a little bit. Now, let me bring up a subject now that I think we have a little bit more, well, not too many more people here, but I know some people will be watching this video tomorrow morning. So I'm going to bring this up here. Back to our Blackboard, to the file folder project paper. All right, remember this is our project for the summer. Going to download a 10K, and I have a sample of a 10K tonight. I'll show you that in just a minute. And you're going to be answering the questions from this overview document that lists a series of questions I want you to look up and find the answers in the 10K. I've given you a sample paper of that you can see. And also in the discussion forum, I've asked you to give me selections of your paper companies. Now, according to my distinctive calculations, Sandy, Ashley, Nolan, Cynthia, Daniel, Jan Lee, Jessica, oh, scratch off Jessica, I have her. Let's do that again. Let's try that again. Sandy, Lisa, Ashley, Nolan, Cynthia, Brian have yet to select companies for their thing. I think, Brian, you did AT&T, but I didn't get a confirm back from you if that was the one that you actually decided on. If you're here tonight, Brian, just confirm that you would be doing AT&T.
Excuse me, Mr. Hasse. Last class, we agreed that we were going to do Nike for me.
Yeah, but I thought you were also going to make it official by posting it to this file folder, but that's okay, Cynthia. So you're going to be doing Nike.
Yeah.
Okay, that's okay. That's why we're doing this.
Okay.
Professor?
Yes.
This is Daniel. I had confirmed that I was going to do Berkshire Hathaway.
I have you down for that. Thank you, Daniel. Thank you.
Okay,
I missed that. You're okay, Daniel.
Okay.
Okay. So if you have not selected a company yet and you're listening to this video, please do so. Here's why. Let me show you. This can get a little bit technical if you don't pay attention to this project. And then you're going to be all panicked the last weekend that you have to do this paper, and then you're going to get mad at me. So let me show you something. I went ahead and downloaded this document. Nobody has selected Ford Motor Company. This is the 10K for Ford Motor Company. I went into Google and I just said Ford Motor 10K. And I went to December, the last fiscal year of them, 2019. I either went to the Ford Motor Company corporate site or I went to the Securities and Exchange Commission site and I downloaded this PDF, which is 202 pages long. You don't want to print it out, all right? It's a big document for every company that you all selected. Hundreds of pages. And this is a document that every corporation in America has to has to prepare and post to the Securities and Exchange Commission for the public to see of their current data through their current fiscal year. Your job is to go through this document and find the information that I ask you to find and put it into your paper format. And you'll see a copy of that paper format, a sample paper, in that file folder. And as I suggested a couple of weeks ago, it might be wise to do these in segments, not wait to the last weekend and spend 4 or 5 hours on this and you're driving yourself crazy. Because at the same time that last week, you're going to be doing an examination on multiple chapters in the second half of our class. It's best to get this out of the way. This is an easy A. All you have to do is find the information and post it to the put it in the nice format. And it's an easy A. 15% of your grade. Some of us right now who have 70s, 80% averages in the class, this will get you up another grade point. This is a good thing. And also at the same time, it allows you to see the end result of the accounting cycle for all these companies, their financial data. Some of it can be overwhelming, but that's what I want you to do. Okay? So this is a sample of the 10K. This is what you want to see for your company. Now, some of you will have fiscal years different than December 31st. That's okay. Just got to make sure that it says not for the quarter, but for the fiscal year ended March 31st, November 30th, whatever. That's what you want. Okay. I'm going to post this sample 10K to the file folder just so you see what it looks like. So when you download your particular companies, don't print it out again. Download it and just use it like this, like I'm doing, to find the various. It gives you a table of contents. You can find the pages that the information is on very easy. But it gives you some real world exposure to what the end result is of all this accounting work for corporations. That's important. Because you're going to use this information when you go to your next class, Business 3030, whenever that will be for some of your schedules. And you'll be using this information also in that class. So that'll give you a good head start into that class. So again, for some of you, make sure you give me your company's name. So when you do contact me and you say, Professor Hasse, I'm having a heck of a time with my company. What company do you have? I'll know in advance what company you're working on, and I can prepare myself should you have any questions or concerns. You see, what I do is I have to download this information. Then I have teaching assistants who will go through your papers and double check your information. You think I'm going to do all this? You're crazy. I have a couple of former students of mine who are in graduate school for a couple extra bucks who will do this fact checking for me once you submit your papers. And I have to know which companies you have so I can get that data ready for those students to do the number checking. So that's how this all works. By the way, speaking of, if any of you graduate from Laverne or get your business degree and are interested in being a teaching assistant, that's a good way of making some extra bucks. I pay $20 an hour for students to help me with my grading and my preparation for my classes. So that's a nice little way to make some extra bucks. And also, if any of you are ever planning someday to be a teacher, this gives you a little experience and looks good on the resume. So just keep that in the back of your minds. I hire teaching assistants every year to help me with my variety of my courses. So that's something. That's how I started into teaching. I was a teaching assistant in graduate school for a professor, and that's how I said, you know, I think I could do this. So that's just something you might want to think about. Okay, there's that. Okay, now let's do this. We're talking about Chapter 10. And if you remember from the midterm examination, I gave you a problem, adjusting entries for the Dunlop Company, where you had to do some adjusting entries for two different types of assets. I think it was an equipment, and I think the other was a building. And you had to do depreciation entry, debit depreciation expense, and credit accumulated depreciation. Well, in Chapter 10, we learn how to calculate that information. Remember, plan assets. Now, what's a plan assets? And as if any of you saw the introduction video for today, this class, plan assets also can be called property, plant, and equipment. They also can be called fixed assets. They also can be called long-term assets. They all mean the same, just some companies call them by different names. That's what can get confusing. But there's 4 different types of issues with plan assets. First of all, how much you're paying for it at acquisition. Okay. What is the life of that asset? What is its life, how long you're going to financially or accounting-wise use it? Record the depreciation expense over that time by whatever method you select. And there's 3 of them, I believe, that we're going to work on. And 4, record the disposal of the asset at the end of its life. Either you'll sell it or scrap it out, whatever. Record the disposal of it. Original cost, how long the life of the asset, depreciation expense every year during that life, and a recording of the disposal of the asset. That's what we're doing in Chapter 10. And here's why this is so important. I know this is going to sound kind of geeky, but it's very important to businesses. When you record depreciation expense in an adjusting entry, you're creating an expense of the business, right? Reducing your revenue It's part of your total expenses on your income statement. You're reducing. But when you record that depreciation expense, are you spending any money? No. You're not writing a check to Mr. or Mrs. Depreciation. You're just recording debit depreciation expense on a building, credit accumulated depreciation on a building. You're not spending any cash. You're getting an expense, which is reducing your tax liability on the revenues that you generated from this asset without spending any money. That's a tax break. That's huge. If I'm going to relate this to personal finance, if once you start making money, or some of you probably already have done this, once you start accumulating revenue, wealth, cash, what are the first thing a financial advisor or one of your homeboys tell you? You need tax deductions. You need to shelter some of your money from the government. And what's one of the best ways of sheltering money from the government for us? Is to purchase assets that we can depreciate. So you buy a second home and you rent it out. And you can expense that property over time, reducing your tax liability and technically creating cash flow from that asset. That's one of the first things a financial planner will tell you if you go in to see a financial planner. I'm paying too much money to the government taxes. What can I do, Mr. or Mrs. Financial Planner? You need to purchase assets and shelter your income. And the depreciation is one of the main reasons for that. Very important. And one of the main reasons for companies to depreciate is to shelter these assets and expense them over time. So the depreciation process, ooh, high tech, Mr. Hasse, cool. Depreciation process of allocating the cost of a planned asset to expense in the accounting periods benefiting it from its use is what I just said. You acquire the asset, you put it on your balance sheet, you expense it through the income statement over the period of time. So 3 things you have to be concerned about when you're calculating depreciation. What you paid for the asset, what's its disposal or salvage value estimated at the end of its life, and how long is the useful life of that asset. Now, in regards to the cost, that's pretty easy to figure out. I write a check, I spend money to acquire an asset. The salvage value is a little bit tricky. And that's going to be based on your CPA firm or your purchasing department or even the vendor you bought the asset from. They'll say, you know, we estimate that at the end of its life, it's going to be worth this. Okay, thank you. And then how many years of life you're going to have of that asset is determined by the Internal Revenue Service. Every asset in the world is accounted for in our tax law and tax tables about its useful life. Computers, 3 years. Office equipment, 5 years. Furniture, 7 years. Telephone systems, 10 years. Buildings, 20 to 30 years. Whatever. They all have a useful life. In our class, that useful life will be always given to you. But if any of you are going to become a CPA someday, you're going to have to understand where you look for and where you find this information in the tax code. Scary. 3 methods you need to be familiar with. These are the 3 common methods for simple depreciation calculation. Straight line, units of production, and declining balance. Straight line, units of production, declining balance. These are the 3 you need to be familiar with. There's a couple of more, but you don't have to worry about that now. This is the 3 main ones for beginning accounting programs. Okay? This is taken right out of your textbook. Hopefully most of you have already read this. Well, here we have an example here. We have a product, an asset that we just purchased for $10,000, okay? It has a it has a salvage value of $1,000. That means you're going to depreciate $9,000 over its life. You're going to depreciate that $10,000 down to its salvage value. It's estimated to have a 5-year life. And it's going to be anticipated to produce, this is a product that maybe makes shoes, I guess, 36,000 shoes over those 5 years. Again, these are all estimated. They'll all be verified by a third party. But that's how it works. So now we're going to take this information and determine the depreciation under these 3 methods for this asset, okay? Remember, to determine the cost, we have to determine the purchase price plus any expenditures needed to prepare the asset. For example, you buy a piece of equipment, especially these days with technology, you buy the equipment and then you have to buy software. You have to buy applications that are installed into that equipment or into that asset to make it run efficiently. Those additional costs of software or setting up the asset are other expenditures. You combine both of those to equal the acquisition cost. All different examples of assets. Notice land is not depreciable. If I own a piece of property, I can depreciate the building on that property, but I cannot depreciate the land. Okay. Give you a rule of real estate. The most important asset in real estate is the land, not the building, not the house, the land. That's the most important asset. Now, a couple of companies can depreciate land, but it's not called depreciation, it's called depletion. And guess who you think those companies are? Oil companies, who buy tracts of land and take the oil out of that land. If you're taking something out of the land, you can depreciate it. It's called depletion. Okay. If I own a winery and I have vineyards and I invest in those vineyards which are part of the land, those are depletion or can be depleted, depreciable. That's why a lot of people, rich people, buy vineyards up in your guys' area, Santa Maria. A lot of vineyards up there. Why? A lot of rich, wealthy people have come up there in the last 20 years and bought up real estate and then put vineyards on them. You're sheltering tax money there by depleting those investments into the land of those vines. There you go. So that's how all that works. Okay. Now, let's get to the calculations and show you those examples. Here's the straight line method. Remember, we had $10,000 cost. We have a salvage value of $1,000, making the depreciable cost $9,000. And the life of the asset is 5 years. So the straight line method is to take that depreciable cost and divide it by the useful life, $1,800. So every year for 5 years, we will be doing a depreciating adjusting entry, debit depreciation expense, $1,800, credit accumulated depreciation, machinery, $1,800. And at the end of the 5 years, we will have depreciated that down to its salvage value of $1,000. That's the straight line method. Pretty simple. Cost minus salvage divided by life. It's the same amount every year. Units of production. Units of production is a two-step process. Step 1 is to determine the depreciation per unit by taking the cost minus the salvage value, dividing it by the estimated amount of units you're going to produce out of that asset. And then the step 2 is taking that depreciable per unit and multiplying it times the number of units you actually produced during that year. So for our example here, let's assume we produced 7,000 units during this first year of operation. Remember, we said we have a cost of 10,000, a salvage value of 1,000, a depreciable cost of 9,000, and now we're going to take that and divide it by the total units we anticipate making, 36,000. 9,000 divided by 36,000 equals 25 cents a unit. That's our depreciable base. So now we take 25 cents per unit times the actual units of that year, 7,000. There's our depreciable amount, $1,750. Every year it's driven by the number of units you produce during that year. That's the units of production method. You develop a depreciation cost per unit and multiply that cost per unit times the number of units during that period. Units of production. And this is how it's calculated over its life based on the units you anticipate, hopefully, to produce. And now we get to the the declining balance method, which is a little bit even more complicated. Again, these three methods fit into whatever business type or asset type you're operating. A company can select these three methods. Once they select a method, they have to keep it for at least 1 year according to the IRS. You can change methods after the end of the year, but once you select it for this year, you got to use it. So the straight line method, again, here's that problem again. It takes, question.
Could we look at your screen, please?
You can't see it?
No, we're looking, at least I'm looking at you.
Yeah, I can't see it either. I thought
now you guys tell me this. You tell me this after I get through the whole thing? That's not too smart, but I guess I'm not too smart by somehow losing track of that. So, hang on. Okay. Now you should see it, correct?
Yeah, that's good.
Thank you. You want me to go back through that again?
If you can do it in 2 minutes, yes. What's your PowerPoint lecture on?
This?
Yeah, which ones are you using? Is that chapter 10?
Yes.
Okay.
Okay. Remember, we have three amounts to be associated with an asset to depreciate. What we paid for the asset, the cost, the anticipated salvage or disposal value of the asset at the end of its life, and the estimated life of the asset over time. That life is determined by the Internal Revenue Service, who codes every type of asset into classes and determines that. You will be always told what the useful life is. You will be always told what the salvage value is. You'll be always told what the cost is. Salvage value is determined either by your public accounting firm or the vendor or the person who you purchased the asset from to give you that estimated ending value. So let's say we have a problem. There's 3 different depreciation methods you should be concerned about. Straight line, units of production, declining balance. Those are 3 different ways of allocating expenses of assets. It's kind of like in inventory. We had 2 methods, FIFO and LIFO, of determining ending values of inventory assets. Here under plant or property, plant, and equipment assets, fixed assets, we have 3 methods we can select. Straight line, units of production, and declining balance. And again, not to totally confuse you as an accounting student, but having 3 different methods gives 3 different options to companies of allocating costs over a period of time. So we have an example here. A cost of $10,000, a salvage value of $1,000, a depreciable cost of $9,000 over an accounting life of 5 years, and an expected production level of this particular machinery of 36,000 units, or in this case, shoes. So what is the straight line method to determine this? Here it is right here. The straight line method is the same amount every year, where the other 2 methods, the units of production and declining balance, can change year in and year out. The straight line method is the same every year. You take the depreciable cost, which in this case is $9,000, divided by the estimated life of the asset, you get $1,800. And so every year you will adjust your accounting records by debiting depreciation expense, $1,800, and crediting accumulated depreciation, $1,800, reducing the value of the asset down to its disposable or salvage value of $1,000 over the life of the 5 years. That's the straight line method. Units of production method is a 2-step process. You have to determine the depreciation per unit and then take that depreciation per unit and multiply it times the number of units produced actually in that given year. So in this case, for this problem, we have a depreciable cost of $9,000. We divide that by the total amount of units we expect to produce from this asset, which is 36,000, and we get 25 cents a unit. Then we're told that 7,000 units were used or produced that current year. So we take the 7,000 times the cost per unit, we get $1,750. That's our depreciable expense for that year. Debit depreciation expense, $1,750. Credit accumulated depreciation, $1,750. It's based on the unit per unit depreciation times the number of units produced that year. A lot of companies, if they own their copy machines, this is how they depreciate copy machines. If they own them, a lot of companies rent them or lease them. But if you own your copy machines, you determine your depreciable cost. Your vendor of who you purchased a copy machine might say you're going to get 500,000 copies out of this during its life. You determine your depreciation cost per unit, and at the end of every year, you look at the counter on the copier. That's how many copies you made this year times that unit. There's your depreciation expense for the copier. That's an example of that. And this would be a history of that. If we produce different units during its life, that's the different depreciation we have every year during its life. Units of production. And then we get the declining balance method, which where we were left off after I forgot to show you these slides. Declining balance is taking the straight line rate. In this case, remember this asset has a 5-year life. That means 20% of a year is going to be the straight line rate. We're depreciating 20% a year straight line. We double that. So we double 20% to 40%. And then our depreciation is based in the first year at taking the rate of 40% times the beginning period book value. In this case, year 1, it would be $10,000. We do not include the depreciation or the salvage value in this. We take double the straight line rate times the beginning book value, $4,000. That's the declining balance. In other words, we're probably going to expense a lot more in the early life of the asset and not so much towards the end. And let me show you that. So for example, the first year I would take 40% of 10,000, I'm going to depreciate $4,000. So at the end of that first year, my book value goes from 10,000 to 6,000. So now in the year 2, I take 6,000 times 40%. There's my depreciable amount. I take that now and my book value is $3,600. $3,600 times 40%, 40%, and then the next year you adjust it down to just the amount you can depreciate in that final year has to total to the $9,000. So we depreciate down to $9,000, but we do it at a double declining rate over its book value over its life. And notice we're depreciating a lot more in the early years when the asset is considered more valuable and depreciating less towards the end of its life. Straight line, same amount every year. Units production based on how many units you produce a year. Declining balance, depreciating more in the early life as the book value decreases, that amount of depreciation is lessening. Those are the 3 methods for depreciation. This is taken right out of chapter 10. When we come back from our break, we're going to take a look at problem 10-2A and do the depreciation schedule under straight line, units of production, and declining balance for that particular asset on page 388 of your text. Problem 10-2A. And we'll do that in class after our break. Okay, so let's take a break. I'll see you guys back at 20 minutes after the hour. 20 minutes after the hour. See you then. Thanks. Okay, we have a poll this evening for our accounting week 7. The poll is, today's the first day of the baseball season. Who will win the championship of Major League Baseball this season? Houston Astros, defending American League champions. Los Angeles Angels, historically a bunch of has-beens. The Los Angeles Dodgers, the wealthiest team in the baseball. The New York Yankees, the second wealthiest team in baseball. And the defending World Series champs, the Washington Nationals, or an other team. I'd like to know what that other team was. And the final question is, I don't care, Professor Hasse, just help me get an A in accounting. And I had a feeling that would probably be the most popular selection of this. And let's take a look at that. All right. Hang on, I got a chat here. Brian Rodriguez likes the Dodgers. Brian, you just lost 5 points on your next quiz, number 3. Only teasing. All right, I'll give you 8 of the 10. Let's give it a couple more minutes, let everybody finish. Jessica Murray, did you vote? All right.
I didn't see it. I don't see it. It's not here on my screen.
Sorry to hear that. Jessica, do you see it on your screen?
I joined in late because I was at a family thing.
No, but do you see it on your screen now?
No, I voted and it went away.
Okay, yeah, once you vote, it goes away. So Michelle, did you vote?
No.
Well, sorry to hear that. I guess if you don't see it, I guess you can't vote. So don't worry about it. It's no big deal. This is just a fun thing. All right, 8 of our 10 students have voted. Let's share the results with our students. And there we have it. As you can see, the majority are saying, I don't give a RA, Mr. Hassey, about baseball. I just want to get an A in accounting. And I don't blame you all for that selection. That's what it should be. Okay, so that's our little poll for tonight. Let me take a picture of this for my own historical analysis. And there we go. Okay, well, let's get back to accounting. At the beginning of class, we talked about the project paper and those students who have yet to select their selection. Let's take a couple moments, and I talked about this in our introduction video for this evening, but let's take a look at our midterm examination. The midterm examination was basically to complete an accounting cycle for the Dunlop Corporation or Dunlop Company, and then also do some retail accounting journal entries to make some adjustments and fill in the blanks of a retail financial income statement, and then calculate the FIFO and LIFO for a company. There were 5 questions in the examination, and each question was worth 20 points. And this is the solution file for that. And even though, and I think I mentioned this in our introduction video for this evening, you are not going to be assessed or tested on this material again in our class. This is it. The midterm examination, the last examination of our class in a couple weeks starts with chapter 8. So you're not going to be tested again on the accounting cycle. But if you did miss a few points, you should make sure where you went wrong to make sure, because you'll need to know the accounting cycle as you go forward in your business program. When you take additional classes, knowing that cycle, knowing the financial statements, knowing the 10K from your work in this class will help you with other classes. Knowing how to read the financial statements will help you in the other classes. And so I urge you, if you have some questions on that, come to our office hours on Tuesdays, or come and let me know about a Zoom meeting to go over these and make sure you're familiar with how to do this work, even though we will not be assessed this anymore in our class. In the solution file that I posted to Blackboard under the midterm examination, I have a variety of tabs. Here's the journal entry tab for the original entries of that Dunlop company. Then the general ledger tab showing the general ledger of all the accounts. The unadjusted trial balance, the first trial balance you had to do in that examination. Then the adjusting entries that I gave you to adjust and then prepare an adjusted trial balance. And then with that adjusted trial balance, prepare the financial statements. And here they are here. Now, if anything that a lot of people missed and got a couple of points off for was making sure the headings are correct. The name of the company, the financial statement, and the period covered. If you just put down March 31st, that's incorrect. It's for the month ended March 31st. The only time you should have March 31st is as the balance sheet. That's as of March 31st. But the owner's equity statement and the income statement are for a period of time ending March 31st. You need to show that in your heading or nobody will know what's going on with that information. I took a lot of points off for a lot of students for missing that. Then once those statements are done, some of us had a difficult time with the closing entries, closing the temporary accounts of revenue, expense, and withdrawals, and then a post-closing trial balance, completing the accounting cycle for the Dunlop company. So that was the cycle and the steps of the cycle I was looking for in the midterm. You all did very well on the retail entries. Some of us had a little bit difficult time with when we had to return items. Once we purchase them, they go directly out of merchandise inventory. Some of you put down discounts. They all go back to inventory for returned items. But all of you did very well on those entries for retail accounting. All of you did very well on the fill in the blanks of the income statement for the Corman Company. We are looking for A, B, C, D, and E, and here are those calculations and how I did those. And then finally, everybody did a very nice job with the inventory for FIFO and LIFO. So on the whole, the class average for this midterm was an 87.22. That's a B+. That's pretty good. I've had a lot worse in a lot of other classes. 87 was the average for this midterm. That is excellent. You guys are to be commended. And especially in this online remote environment where I'm not in front of you up in Vandenberg or up in Lompoc. This is an excellent job, and I commend all of you for your hard work on this. So thank you. Excellent work. And 87 was our class average. That is outstanding. Nothing to shake a stick at. It's excellent. So thank you for that hard work and for doing that. So again, here are the solutions posted to Blackboard. If you want to take some time and go through those, but again, yeah, I'm not going to assess or test you anymore on this information. It is done. So I think the key thing to remember as going forward in this class into other classes is the financial statements. Knowing what they tell you, what's the end result of all your entries in accounting cycle, what the financial statements tell you about a company. That's the thing that you'll be carrying forward into other classes. Okay, so that's the midterm. And again, a fine job. All right, now let's go back to our depreciation problem. We're on page 388. And here it is on your screen in front of you, a worksheet that I have put together that we're going to do this problem. And this is, again, problem 10-2A on page 388. And you should note this for your records. This is a sample problem that you'll again practice in the quiz this coming week. And you'll have something similar to this on your examination in a couple weeks. So first of all, they tell us in this problem that we have a machine that's costing us $257,500. That's the cost. They tell us it has a $20,000 salvage value, and it has a 4-year life, And it tells us, it gives us information of how many units it will be producing in every year. 220,000 units, 124, and so on. The total amount of units that it estimates to produce are 475,000 units out of this machine. 475,000 units. That's the number of units they estimate to produce. Remember, we just went over that before our break. So we're asked in this problem to determine the depreciation schedule for the 4 years of this asset using straight line, units of production, and double declining balance methods. So let's use the straight line, because the straight line, remember, is going to be the same every year. So remember, our straight line method is the depreciable cost, which is the cost of the machine minus the salvage value, divided by the life of the asset. So in this case, it's $237,500 divided by 4 years. That's $59,375 a year. If you look at my formula in that cell, it's the depreciable cost divided by the life. So every year you'll be doing an entry, debiting depreciation expense, $59,375, crediting accumulated depreciation, $59,375. And notice it totals the total depreciable amount right there, $237,500. 237.5. So we're depreciating that asset down to its salvage value of $20,000. Pretty easy. Now, first of all, remember, we also have the units of production method. And if you remember, the units of production is a two-step process. First of all, what is the depreciable cost? We've done that, $237.5. And we divide that by the number of units produced over the life of that asset. And we get a depreciable unit. So 257.5 minus 20,000 is 237.5 divided by 475,000 equals 50 cents a unit. That's our depreciable unit cost. Then in the first year, they tell us in the problem that we're going to depreciate 220,000 units that year. It says year one, the number of units in year one is 220,000. So notice what I do. I take 220,000 times my depreciable amount, 50 cents a unit, and I get 110,000. In year two, they tell us we're going to use 124,600,000. I take that times 50 cents. There's my depreciable life. Notice the more we use the machine, the greater the expense. In year three, they tell us we're going to depreciate 121,008. Multiply that times 50 cents a unit, $60,900. And then in the final year, we're going to depreciate or have 15,200 units times 50 cents, 43,000. Why 4,300? Notice, if we take 15,200 units times the 50 cents, it's actually $7,600. But remember, we have to total 237.5. So we have to match the ending salvage value. So in year four, we have to adjust and only can depreciate not 7,600, which is 15,002. In other words, we used more units than we estimated. So in that final year, to depreciate it down to the salvage value, we can only expense 4,300 to equal the $237,500. So that's something to note. in the problem we looked at before our break, it came out exactly right. In this problem, we are using more units than we estimated. We only can depreciate down to that depreciable cost. Thus, we match that with that amount to come to 237.5. Okay. The declining balance method, remember, is a 3-step process. If this is a 4-year life asset, that means straight line, we're depreciating 25% a year, equals 100%. So in the straight double declining balance method, we double that rate to 50%. And now we're going to take that 50% times the book value every year to get our depreciation schedule. So in the first year, we're going to take $257,500, the total cost. We do not include the salvage value in this discussion, and we get $128,750. Then in year 2, we take that our new book value is going to be down to, remember, we're going to take 257.5 minus what we've depreciated up to that point in time, and we're going to multiply that by 50 cents. In other words, our book value drops. Here our book value is 257.5. Now our book value is going to be 257.5 minus what we depreciated in year 1, 128,750. 128,750 times 0.5 is 64,375. Our book value balance at the end of the next year is 128,750 minus what we depreciated in year 2, 64,375. Thus, that times 50 cents, or 50 cents, is 32,188. 64,375 is our book value at the end of year 3, minus what our year 3 depreciation was, is now 32,187. So what we depreciate in year 2 is not 50 cents times 32,187. Again, we have to come down to our salvage value.
Hi.
So our 12,187 is a fill-in amount to make sure we now total 37.5. Notice in all three. Notice in all our depreciable amounts, we total the 237.5. With units of production and declining balance, we had to fill that in so we could total that amount in the final year. So this schedule is showing a company, we have a lot of companies that keep different sets of books, and they always track these to see what is the best depreciation method for them to record. Straight line, the same amount every year. Units of production based on the volume of production in units, and the declining balance method, taking double the straight line rate and expensing it more in the early years than the later years. We need to be familiar with these 3 methods. Here's a template to show you how to do that. Now, when I give you an adjusting entry for depreciation, I will not give you the depreciation expense amount like I did in the Dunlop company. You will have to calculate the depreciation amount based on the information of the cost of the machine, the salvage value of the machine, the number of years of life of the machine, and the units produced, estimated of the machine during its life. Once you have that data, you can produce these 3 different schedules. Okay, again, notice when we were working on the first half of our class, we were doing the accounting cycle, doing the basic steps of accounting. Now, after the midterm, we're getting a little bit more specific with our accounting. We're concentrating on certain areas of our financials, of our chart of accounts, to find specific information, internal controlling, reconciliation, detail. In Chapter 8, it was reconciling cash. In Chapter 9, it was understanding accounts receivable. In Chapter 10, it was recording the expense or depreciation of plant assets. In Chapter 11, it's understanding liabilities, accounts payable, notes payable, liabilities, and that's what we're going to look at next. Okay. Remember I said in just said that Chapter 9 was about receivables, assets. People owe you money. Chapter 11 is you owe people money, liabilities. Okay? There's two types of liabilities. One liability is called current. It has a life of less than 1 year. You got to pay it back within the next year. That includes accounts payable. That includes accruals, sales taxes, payroll taxes, all liabilities you have to pay within a year, sometimes even quicker. Then you have long-term liabilities. Those are due over a year. Mortgage payable, notes payable, bonds payable, liabilities that you pay later on. But here's the difference between not only time between current and long-term liabilities, you pay interest on long-term liabilities. Interest. That's the difference. Accounts payable, if you don't pay, all right, then you might have to pay interest because you're overdue. But if you pay within the 30 days, you don't have to pay any interest. Long-term liabilities come with a cost. It's called interest. These are all different types of liabilities. Current liabilities, accounts payable, sales tax payable. You know, when you, and you guys know this, when you purchase something, when you buy something, you have a sales tax you have to pay. That sales tax is collected by the company that you purchased your product from, and they send that sales tax money to the county or the state. And sales tax money ends up going back into your communities as revenue for your cities and counties to run. Another example of a liability you guys know about is unearned revenues. We saw those in earlier accounting cycle entries. Short-term notes payable. Short-term notes, meaning it has a life of less than a year, but when it says notes payable, that means interest is associated with that. We're going to see that example in just a minute. Payroll liabilities. Oof. How do companies get in mucho trouble with the IRS? Every paycheck, they withhold federal taxes, state taxes, SDI taxes, Social Security taxes, Medicare taxes. They withhold them from your paycheck. They have 30 days to take that money and send it to the feds, to the state, to the EDD department in California, to the IRS department. I believe out here it's in Utah. You have to send that money as withholdings for your employees. Sometimes companies don't actually do that, and then they get in trouble because they spend that money before they have to send it to the tax people. So those are the different types of liabilities. This is what I meant earlier by giving a note. Let's say a company, the Brady Company, owes some money, $600, okay? they can only come up with $100. And they say, all right, can you give us some time to pay back this money? Can we sign a note for $500 and pay you back in the future? Because we sign a note, we're willing to pay you interest. Geez, loan sharking, 12%. Do you know what a mortgage rate now for a 30-year mortgage is 3%? Good Lord Almighty, 3%. If you have good credit, which means a FICO score over 650, you can get a mortgage for 3%. Holy moly, pretty low rates. Well, in this case, Brady Company cannot pay their accounts payable, so they'll say, all right, we'll give you $100 and we'll sign a 60-day note. In other words, we'll pay you in 2 months the $500 back plus 12% on that $500. Okay? Going to give you a personal experience. If you're going to lend money to somebody you trust, charge interest. I don't care if it's your brother, if it's your cousin, if it's your grandpa. Take it from personal experience. If they're going to pay you back over a period of time, charge them interest. You know why? Because you're related to the son of a gun, they won't pay you. But as long as you have a note, they're legally obligated to pay you plus interest. You can take them to small claims court. And you're going to think this is awfully mean, but I've taken my family members to small claims court because they don't pay me back the money. I know that sounds rather harsh, but really, I could do something else with that $500. Why should I wait for you to pay me 10 years from now? Interest is a good alternative to making sure people pay. I know that sounds awfully mean, but trust me from prior experience. Okay, whatever. Okay. So here's the journal entry to change that accounts payable into what is called a note payable. Debit $600, wiping out the liability of the accounts payable, giving the McGaw company $100 cash, and now assuming a new liability called a note payable for $500. Oops. So now, 60 days later, they're going to pay back the money. So at the end of 60 days, now the note payable is due. The only problem is you're not only going to pay them $500, you're going to pay them interest. And so you have to, as an accounting student, learn how to calculate interest. And notice my interest calculation here. $500 is the amount of the loan. The interest rate was 12%, but remember it was only for 60 days. So I take the 12% times 60 divided by 360 equals $10. And why 360? I keep it simple. Yes, there's 365 days in a year. And yes, young man, son of Jessica Murray, always collect the interest. When you're old enough, you'll thank your lucky stars, I told you this, collect the interest. You can even wear your pajamas and still collect the interest. So notice what I did. $500 times 12%, which is $60, times 60 divided by 360, which is 1/6. 1/6 of $60 is $10. Question, Jessica?
For some reason, my computer won't look at your screen. It's just looking at, like it's looking at you.
Does everybody see this? Everybody see, Blanca, you see the screen?
Yes, I do.
Sorry, Jessica, I don't know why.
Okay. I'll figure it out, I guess.
You can also watch the video later on too.
Okay.
Okay. So if you want to leave the class, go ahead and just catch up with the video later. That's fine by me. Doesn't make you do what you want to do. Okay. All right. So notice my journal entry here. I'm recording the interest as a debit to interest expense, 10 bucks. And the cash is credited $510. So now I'm paying back the loan. The principal was 500. The expense was 10 bucks. That's the interest. And there's the calculation. And now I'm paying the check or the cash for the total. This is what you have to do in Chapter 11. Understand this calculation and this entry. Converting an accounts payable into a note payable and then being able to calculate the interest. Because again, in business finance and other classes that you are going to take in your business program, you're going to need to understand the concept of interest and the calculation thereof. So there's that example from your work. So let's look at a problem that practices this. All right. I'm on page 426 of your textbook. 426, and I'm looking at problem 11.1a. 11.1a. Okay. It tells us that we're taking on a few loans. Welcome to the club. Welcome to the world. We're taking on some debt. So I have set up a spreadsheet to calculate this. And here it is right here. It looks a little confusing, but it'll make sense as we go through it. And then we're going to record the journal entries given in this problem. Okay? So I'm on top of page, did I say 426? Page 426, problem 11.1a. April 20th, year one. We purchased $40,250 of merchandise on credit from the Locust Company. Terms net 30. What's the journal entry for that? Merchandise inventory will be debited $40,250, and we credit accounts payable. We owe the Locust Company $40,250. All right, fine. May 19th. Jessica, can you see this screen with the spreadsheet?
Yes, I just logged off and then joined back. When I joined back,
Oh, good, okay. On May 19th, replace the April 20th accounts payable with a 90-day, 10%, $35,000 note payable, and we're paying the balance, $5,250 in cash. So just like the example we saw in the PowerPoint slide, we're now going to wipe out the liability, debit accounts payable $40,250. We're going to pay cash $5,250, and we're going to now take on a note for $35,000. So now we're converting this liability for short term into a longer term note. And I have it right over here, Locust. 90-day note dated May 19th. 90 days from May 19th is August 17th. All right?
good day.
That is a good day. Your birthday, Jessica?
My birthday's tomorrow, but my anniversary is on the 17th.
Jessica, your birthday is very close to Professor Hassey's birthday. Congratulations. You'll get some extra points on the quiz this week. I'm teasing. Okay.
Can only hope.
So your birthday's tomorrow. Does that mean you're a Leo?
Yes.
Congratulations. All Leos are good accountants, I might add. All Leos are good accountants.
Wow.
All right. So let's calculate the interest on this while we have it, because we're going to end up paying this interest down the road in this problem. So notice we're taking out a 90-day, $35,000 note on May 19th, and that means 90 days. If you look at the calendar, 90 days from May 19th is August 17th. All right, so $35,000 note at 10%, 90 over 360. That means if I calculate that correctly, I'm going to be paying $875 in interest. $35,000 times 10% times 90 divided by 360. 90-day note divided by 360 days in the year, to keep it simple. That ends up to be $875. So note that later on. That's how much we have to pay. July 8th. We borrowed $80,000 cash from NBR Bank by signing a 120-day, 9%, $80,000 note payable. We borrowed $80,000 for 120 days at 9%. What's the journal entry for July 8th? We got cash, $80,000. And we now owe $80,000 note payable credit to NBR Bank. All right. And I know the concept of this borrowing money seems kind of different for some of you, but if you own a business, many small businesses borrow money short term. Depends on their cash flow, depends on when money's coming in or out of the business, but many times companies take out short-term loans like this from banks. So look it up here. Here's the National Bank loan right here in this column. This is 120 days. Notice the date of the note is July 8th. So 120 days from July 8th is November 5th. Look at the calendar, November 5th. This is an $80,000 loan at 9% for 120 days. Put that into my interest calculation. I get $2,400 of interest. $80,000 times 9% times 120 divided by 360. $2,400. All right. Let's continue on. Now we know we're on the next date, which is unknown in the problem. We do know it's going to be August 17th. That's the date that the locust note is due. It's now 90 days, and now we have to pay back the locust note right here. So we're going to wipe out $35,000, paying the note. The interest expense, we calculate it right here. There it is right there, the $875 interest expense, and we're going to pay the locust company $35,875 in cash, write a check. So now we're paying off this loan here of May 19th, right here. The difference is we got to pay the interest in addition to the $35,000, the cost of money. Very good. Now the next transaction, now we're going to pay back the National Bank loan. Remember we calculated that's 120 days from July 8th, that's November 5th. We're going to pay back this $80,000 loan, $80,000, debit, notes payable. We calculated the interest expense as being $2,400. And we're going to pay NBR Bank $82,400 cash check, and that loan is now paid off. There's the interest we calculated there. The receiving of a liability, the transferring that liability to a note, the receiving of cash into a note, and the paying off of those liabilities. Examples. Then on November 28th, remember this is a year ending December 31st, so on November 28th, we borrow another $42,000 from Fargo Bank and sign a 60-day 8% note for the $42,000. So we take out another loan on November 28th, and here this is right here, Fargo. This is a 60-day note, November 28th. But note the due date. 60 days from November 28th is January 27th, the next year. Our fiscal year ends December 31st. We have to be aware of that. So first of all, let's record the entry for November 28th. We get cash for $42,000. And now we owe Fargo Bank the note payable liability of $42,000. We now know, let's calculate the interest. 60 days, $42,000 loan, 8% interest. Our interest calculation, $560. There it is right there. 42,000 times 8% times 60 divided by 360, $560. But remember, this is dated as November 28th. We're going to have to do an adjusting entry on December 31st to record the interest accrued through December 31st. To adjust our books to show the interest incurred in this current year. So I have to do some additional calculations. How many days from November 28th to December 31st? 33 days. So I have to calculate 33 days of interest. So I'm going to take $560, which is the total amount of interest due on that 60-day note, and multiply it times 33 days over 60. In other words, I'm going to calculate the interest from November 28th to December 31st, and that's $308. That means the rest of the loan, which is due, the interest due January 27th of the next year, is going to be $252. 308 plus 252 equals 560. But I have to do an entry on December 31st, debiting interest expense, $308, and crediting interest payable for $308 because I have to show on my accounting the interest incurred up through December 31st because this loan goes into another year. Yes, people do this for a living. Now, on January 27th in the new year, I have to now pay off the loan to Fargo Bank. My interest expense is going to be the interest incurred in 2020, or the new year. So debit 252. I'm going to wipe out the note payable, debiting at 42,000. And I'm going to wipe out the interest payable of what was accrued through December 31st of $308. And the total cash I'm giving Fargo Bank is $42,560. So here, this note or loan is a little bit different here with Fargo is because it's going across two different accounting periods. These other two did not. They all happened within the same year. So in this one here for Fargo, we have to record an accrual of interest through December 31st. And then that accrual is wiped out when we make the final payment in January 27th. And the only interest charged for this year is the interest accrued or earned from January 1 to January 27th, which happens to be the balance of the 560. Ladies and gentlemen, this is a perfect example of Chapter 11. Converting accounts payable into notes payable and calculating the date due and the interest amount in each one of those loans. And a lot of you experience this in somewhat of a way is when you go and buy a car or a mortgage. The crediting or the issuance of your credit is going to give you a coupon book or a series of payments on that loan. They've calculated the amount of interest you have to pay over the life of that debt. If it's a car loan, 5 years. If it's a mortgage, 20, 30 years. And they've calculated all the interest you have to pay on that over its life and divided it into equal monthly payments, less principal over the life. That's called an amortized loan. This is one of the issues or things that you'll learn in Business Finance 330 next time. But here you have a head start on that, understanding how interest is calculated and what it means in incurring a liability. You will see this problem in your quiz number 3 next week, and also on the examination in a couple of weeks. So tonight we looked at 9.2a, 10.2a, and 11.1a. Next week, we're going to look at chapter 13, 13.2a, which is blank now, and we'll fill that in next week. These are the problems this week. I will post this to Blackboard week 7, so you have the template, and you can study this for future reference in additional problems. Okay. So in review tonight, let me wipe this out here. In review tonight, we have gone over a little bit of the basics and the solution file of the midterm. We've finalized and make sure we understand the rules and the regulations of the project paper. For some students, they still have to pick those firms. We showed you a sample of a 10K for the Ford Motor Company, and I will post that sample to the project paper file folder so you can just see it to make sure when you do download your company's 10K, it looks fairly similar. We reviewed one last time Chapter 9 and accounting for bad debts expense in 3 different methods of looking at a percentage of credit sales, a percentage of total sales, and a percentage of accounts receivable to record those expenses. We've learned 3 new methods of calculating the expense called depreciation for plant assets, straight line, units of production, and declining balance. And finally, we learned about current liabilities and converting a non-interest-bearing liability like accounts payable into a note payable. When it says note, it's interest-bearing, and learning how to calculate the interest and accounting for those in a journal entry format. Next week, we're going to be talking about Chapter 13, Corporate Accounting, learning about common stock and how that is accounted for in corporations. And then we're going to be talking about chapters 18 and 19 with specific pages to read that's highlighted in our Blackboard in week 7 this week, certain pages to read out of those 2 chapters, and that'll be my lecture next week. And also now, if you go into your Blackboard account, under quizzes and examinations, you will now see quiz number 3 in a PDF and Word doc format that you can download and answer the 3 questions there. The format for this quiz is your choosing. If you want to use a spreadsheet, fine. If you want to use a Word document, fine. If you want to use a PDF document, fine. Your choosing. I would think a spreadsheet will probably be the easiest because you're going to be doing depreciation calculations, note calculations, accounts receivable, bad debt calculations. Spreadsheet probably would be the wiser. But I know some of you like to use Word and PDF. I have no problem if you decide to use those formats. This work is due next Wednesday night at midnight, July 29th. We have office hours next Tuesday if you have any questions in regard to that work, but I will not be reviewing samples of your work to let you know you are doing it correctly. You're on your own on quiz number 3. So that is your graded work for this week. Plus, you should begin to get some accountability and some beginning work on your paper to ease that over the next few weeks as we get closer to our exam week. So that's our recap of tonight. And again, I have recorded this for posterity and you can review it. Looks like we've lost some students over the course of the evening. Does anybody have any questions?
I do.
Yes, ma'am.
Looking at the quiz in regards to chapter 8 and 9, and I'm trying to pull up the Excel sheets. I don't know why I'm having a problem, but is that what we went over last week?
It is.
Okay.
And also chapter 9, what we went over tonight.
Chapter 9. Okay.
Okay. We did a sample reconciliation problem last week. And also there's a wonderful example of a reconciliation problem in chapter 8. I'm gonna get you on page 304, a lovely example of a bank reconciliation problem on page 304 of your text with examples of the reconciliation, how it was done, and the journal entries associated with that. So you have the template from last week that we did in class, problem, I believe it was 8-4. And on page 304 of your text is a nice description of that process.
Yes. Okay. Thank you.
Okay. Any other questions, folks? Okay. So as I said earlier, we are now at the point in our class where we're now looking at specific accounting control work, toning up, cleaning up assets, cash, receivable, liabilities, to plan assets, doing entries and adjustments to those accounts due to the nature of what is the determination of those assets. Will we collect our receivables? Is our cash account clean and balanced? Is our liabilities, do we owe people money and how much interest is involved? And how do we expense the purchase of plan assets over their life that we're allowed to do by the tax law and recording those expenses over the life of the assets? Very key, specific accounting type things that many companies spend hours and hours and many, many dollars on keeping track of in their businesses. So that concludes this evening. I will hang on afterwards if any of you have any individual questions. Good seeing you all. I hope you're all well and doing okay. We have a few weeks left, and I thank you all for doing such fine work on the midterm. Thank you. And we'll see you all either online in our office hours or next Thursday night. Thanks, everybody. Have a great weekend and a great week.
Have a good night.
Okay, bye-bye. Thank you. Thank you, Maribel.
Bye.
Good night.
Good night. Night, Jessica.
Bye.
Bye, Cynthia.
Bye.
Good night.
Good night, Michelle. I didn't get to see you tonight.
I'm here.
Okay, that's good.